the uncertainty in the market right now?
Yeah, we sort of covered the tariffs and how terrible it would be for everybody involved, and that the big orange bully down south of the border could maybe chill out.
Yeah. Well, what I wanted to make sure I mentioned is, the roller coaster that we've been on when it comes to at least the fixed mortgage rates, or the pricing that the bond yields, which the fixed mortgage rates are based on. And the first red arrow there on the left, that's when the tariffs came out on Monday morning, and you can see how everybody flocked to bonds. They flocked to safety, and just went down. And then that first bump up after that, between the red and the green arrow, that's when Mexico got their 30-day reprieve. And then it wasn't until the end of the day where Canada was reprieved. It was like, okay, there's no trade war, and people could go, take their money out of bonds and go back into stocks and into investments. And then the next morning, there's another dip because the U.S. job numbers don't look so good. They're down to a 4-year low in terms of job openings, and we're right back down to kind of sliding down. And today, at least as of 9:45, we're at 2.667, which isn't as low as it was when there might have been a tariff war. But still, the market is so uncertain right now. Buying Gaza is the next thing. It just seems like we're going to have 4 years of this roller coaster.
We're definitely going to have 4 years of the wildest news cycles, similar to the last time. And, the last time Trump was president, a lot of the news was like, below average quality news about how he misquoted something or mispronounced something or didn't fully understand something. It seems like this time around that it's completely changed, and they're actually reporting on the wildness that's actually going on. They're not just trying to catch him on his trip ups and stumbles, but he is over there, potentially talking about U.S. populating the Gaza Strip. I'm like, I can't even read it,
No. Right. Yeah. It's like, there's so many things coming at you. You almost have to choose, what is it that I'm going to react to? What is real here? What is just him talking, and what is actually something that's going to happen? I think people, and you can see on the bond yield curve, people believed that the tariff war was going to happen, or at least believed enough that they needed to keep their money safe.
For sure. So our US 5-year fix and 3-year fix came down sort of overnight. Where do you think that's going to go now that we have 30 days of reprieve from this rhetoric?
Yeah, I think from their high of maybe where they were last week to today, maybe 25 basis points, 30 basis points down. Like, we're already starting to see some lenders drop below that. Probably start to see some lenders on insured mortgages, so less than 20% down, less than purchases of less than 1.5 million. Probably start to look close to a low 4, maybe starting something with the start of a 3.99 is possible in that realm. So I think that's where we're heading. I don't know how quickly we will get there with all the uncertainty that's happened, but you can see this trend line, even over the last 5 days, is down. Which Tom, did you want to jump in on that prediction?
Yeah, no, I agree. I think that just with a lot of the uncertainty, a lot of people are heading towards bonds, and flooding the bond market will definitely bring the yields down. So with lower yields, we'll have lower fixed rates, and I think definitely 3.99 we'll see soon, and then maybe come late spring, it's just sprayed across the board. We'll see all fixed terms in that starting 3% range.
I mean, it's absolutely great for mortgages and mortgage holders, and it's great for us. It's going to be great for our real estate market as well. But it shows, we had all these predictions up until basically Monday, and this guy is definitely prepared to throw a wrench into all of the plans and sort of change the forecast. Because I'm having a little bit of difficulty wrapping my head around it, because we know when you pull certain levers that the market responds in certain ways. So if we had these tariffs in the U.S., it's going to drive up the cost of goods for the U.S., right? So that's inflationary, and we're going to experience inflation here, which tells you that there's going to be no rate cuts. Although, with the job losses and the softening of the market that it'll create, well, that would tell you that there's going to be rate cuts. So when BMO predicts, another 1.5 in cuts, and I'm thinking, like, where do we wind up with this, with these sort of opposing factors that are kind of contradictory?